Welcome to C2 Biz Growth Iron Sharpens Iron podcast, where CEOs and entrepreneurs share how they are overcoming business growth and sustainability challenges.
Welcome. I'm your host, John Hale III, and we are excited and honored to have with us our guest today, Mr. Glenn Noble. Glenn is the founder and managing partner of Aspen Limited Partners, a financial services holding company with interest in fintech, payment platforms, and specialty finance capabilities. Welcome to the show, Glenn. We're glad you're here with us today.
Yeah, awesome. Happy Friday to you too, John. Thank you.
Yeah.
Thanks for having me.
Thank you. Hey, we're seeing as you're showing up today as a real successful CEO that you've bought and sold a couple different companies we'll talk about later. But can you tell us about when you started your journey? Is there certain experiences from your early career or childhood that really has propelled you forward to where you are today?
Yeah, I don't think there's anything driving, kind of normal childhood growing up, college educated, traditional banking. And then, after kind of 2 decades of doing that, I saw the coolest thing that's going on in finance is all the new ways of doing old things, right? How people borrow money, how people move money, how people invest money. And it's a great time to be an innovator around all those different facets of finance.
Fantastic. And so when we look at Aspen Hill, that's a holding company from a financial services standpoint. Can you talk about the different companies that are within the holding company, and how did you get to where you are today in terms of forming the holding company strategy as you were growing and scaling your businesses, and how do each of the portfolio companies fit within the holding company?
Yeah, so currently we're really focused in 2 areas, fintech payments and specialty finance in the form of mezzanine or subordinated debt. Um, Both of those are a mouthful. And the idea was, when you get into a non-regulated specialty finance, non-commercial bank environment, you sort of need to be niche, big niche, but niche. Because in that regard, you become known for something, right? And an expert in something and the go-to people for something. So that ends up being the ultimate strategy in anybody that goes out and, in my opinion, develops what we're doing or something like we're doing. I want to be the best mortgage originator. I want to be the best, right? You can fill in the blank. Buyout fund. I want to be the best investor in distressed assets, and it goes on and on. So it's not a unique strategy, because a lot of firms that have gone out and have become the go-to source in that particular niche is really, in my opinion, the right way to kind of build a specialty finance or a niche operation.
Great, thank you for sharing that. And so what is your niche then within specialty finance? You mentioned a couple of areas, but what are the couple of areas that you focus on, that you've developed a name for yourself and you consider yourself the go-to player or the go-to firm?
There's really 2 areas. The first one is really in the mezzanine finance, and our role there is to provide capital, typically 3 to 10 million. So we're at the smaller end of the credit size, $3 to $10 million mezzanine loans to later stage operating companies that it's a little bit like Mad Lib, partner buyout. You want to sell the management. You want to do a tuck-in acquisition. You need working capital above your senior bank debt. So it's got a lot of different use cases. And in that regard, we sort of have positioned ourselves as sort of Switzerland for a country that likes to align itself with everybody. In our world, we're aligned very well with the banks. We're aligned very well with the major money center, asset-based lenders, who all like to lend money a certain way. And that way is to lend money to companies that have assets that are security underlying the loan, receivables, inventory, machinery and equipment, buildings. And that's a big business in America. And the banks really cater to it and love those types of companies. Where we find a real need for what we do is when a bank or an asset-based lender has a client that they like, but they love their existing posture. We like to lend money on assets, and there's often an ask from those borrowers for capital that allow them to do things that are above the asset base, and that's kind of where we come into play. So we find that Our distribution model in that business per se, our deal flow model in that business is really around tier one and credible financial institutions that have clients that need capital up and above where they're comfortable lending money.
Right,
Uh,
right.
so that's business number one. Business number two is a fintech called Proudly that we Proudly Give that we started about 4 years ago. And that business was predicated on taking an existing business in prepaid gift cards, incentive reward cards, and just making it a better end user experience, right? Problem in the industry, there's a lot of unremarkable gift cards, right? Big box retailers, food service, coffee. And we said, we're going to build it differently. And so we have programs with both MasterCard and Visa that are built open loop, spend them anywhere. And they're sent on behalf of our clients to their employees, their customers, their referral sources, digital in your wallet with a custom message. So the end user that gets that card feels really good about the motivating behaviors around that, why they got it. They bought more of this, safety record, referrals, and all those types of things. So those are the two main areas: prudent capital on the mezzanine finance, and then Proudly as a recognition, reward, and incentive platform.
Okay. Well, thank you for sharing that, Glenn. And what's amazing about both these companies and the success that you continue to have is that they're already in pre-existing industries, if you will, when you launched and started both of these. So taking them, I guess, in order first with the mezzanine company, uh, Prudent Capital. What was the motivation? I see the business model in where you fit. But what was the motivation to start it, and why did you think you could do mezzanine lendings better than other people, given that there are already mezzanine lenders in the market?
Yep. So with mezzanine is sort of a wide watch there, but I think the niche that we found that we really shine in is on the smaller side, kind of 3 to 10 million in transaction size. And why that's really important, if you go to the banks and ask them what would be the minimum operating income of a business that they would do bank term debt on, you're probably looking at most banks offering $10 million and up from an net operating income perspective before they would provide any type of term debt. So we've taken that same philosophy, brought it way down market to like a $2 million minimum net operating income. And that takes a special sauce of underwriting, right? There's much more sensitivity to client concentration. There's much more sensitivity to industry headwinds, things like that. We're seeing that firsthand now in the DC area with government contractors, right? Where companies that kind of the sky's been blue for a very long time, cloudless and blue. There's a lot of headwinds right now. So we think the ability to kind of, I always say this in finance, generally, two organizations would look at the same thing and see two totally different things, right? So we think our ability to really kind of understand a lot of the nuances industry wide really kind of help us shine. But the fact that we're kind of geared towards the lower end of the market, lower end of the middle market, and to be candid, there's very few players that really kind of will go out and say we want to do deals of that size. So we think the size of the deals and the complexity and the industry expertise really kind of help us differentiate what we're doing.
Gotcha. Thank you for sharing that. And also, it's important to understand, if I'm saying correct, with the mezzanine program, this is a loan, correct? So the companies, from an equity standpoint, you're not taking ownership, or do you take ownership on the structures as it relates to
So we
companies and clients?
have again, one of the really interesting aspects of what we do is we could go either way, right? If we do a loan, it could be interest only, and if we do another type of loan, we may do something where there's an equity component, but we will also collar it, right? Collar it, meaning if you go in and the returns are hit on the loan, it's a little complicated to explain on this. But if the loan hits its return numbers, we could actually either give the equity back or collar it to a certain amount. So we're always on the side of the business owner to sort of minimize dilution. So we could do it with a non-dilutive instrument or a small dilutive instrument, which kind of helps on the return. So if you're charging X straight up with no equity, we could charge a little bit less, and then the equity kicker would kind of make up the difference. So we do not. So the bottom line is we do not necessarily need to have an equity kicker in anything that we do. And I would say Probably more than half the transactions we've done over the years have not had an equity kicker to it. It's been a straight note with an interest, and moves along, allows the company to kind of get to that. What's the use of loan? Buying a partner, doing an acquisition, gets done, gets paid off, and we both keep going.
So this is a tool that is non-dilutive to the shareholders of the company, to the CEOs.
Correct.
That can't be used that way. Okay.
Correct. Yeah, what's really important to us is, the sort of parameters of the types of companies that we finance. So what's probably the number one attribute for us in underwriting is historic cash flow. Can this company service debt, right? And so we're not really the lender to a turnaround, not really the lender to a startup, right? We're the lender to a company that's got operating history, good financial reporting, good financial performance per se, but just the need for the capital, right, doesn't necessarily fit with their bank. And again, there's not a transaction that we've done. There has not been a company that has they all have senior bank lines, right? And we like that. That's a good pedigree. That's the right pedigree for a company. It just ends up being that the banks only have a certain credit appetite on how they want to lend money. And typically, it's not term debt right off the bat.
Thank you for sharing that. No, that's very critical, especially given that lower middle market space in the mezzanine loan area. You really nailed it for a lot of CEOs looking to grow and scale their company of who is your competition. It seems like you have found an area of the market where it was a little bit vacant and you had to be creative or extra disciplined and focused on the underwriting. But with that, you found a very profitable niche, if you will, that you can really grow and expand.
Yeah, like I look at the capital markets and the analogy that I've used when I speak on the subject, I kind of describe it as the shoe department at Nordstrom's, right? Or Nordstrom's rack. You walk in and your head explodes because all you see are shoes. And then when you break it down to, for example, John, what do you need for the shoe? And you go, hey, I'm going to the beach. And then we look at the 10,000 shoes and we whittle it down to the flip flop, right? So the flip flop or the tuxedo shoe or the sneaker or whatever are what I describe as the use of proceeds. I need a flip flop to go to the beach. I need a tuxedo the tuxedo to go to the black tie. I need the sneaker to play hoops, right? The money business works very much the same way. I'm not getting a mortgage, right, to buy a partner out, right? Or I'm not doing an asset-based line of credit to buy a building, that kind of thing. So what happens is I view there's two things that are going on in the lower middle market. And I want to describe lower middle market 10 transaction size 10 million and under. In the capital markets, I believe there's a complete disintermediation on how companies acquire capital under a certain dollar amount. Might be 5 million, but somewhere in that range. What does that mean? That means if you're a company, you need $50 million. Here's your 5 or 10 players everybody goes to and you'll get bids out for it. But if you're an entrepreneur running a company and you need below 10, you need 2, you need 4, you need $500,000, you need some number, it's not really a robust paved road on where you get it. Right. And that's why it's really important when you sort of plant your flag and you tell, in our world, the banks, the investment banks, the accountants, the lawyers, what we do. It's really important to plant your flag and you're thought of in those lights. Right. But because I would say acquiring capital under 10 in certain aspects is you don't even know who the players are. Right.
Right. No, you don't. They're very hard to find, very hard to find. So it's great that you found a niche there. You've been able to expand it and grow it from a prudent capital standpoint. Now, pivoting back to Proudly, gift cards have been around for a long time. You're right. You walk to the superstore, any place, you can see the carousel of gift cards for all these different restaurants. Fast food, takeout, they're all there. And of course, you've got the Visa, MasterCard, American Express. So and now you've got the e-gift cards that you can shoot to people as well, friends, family, coworkers, employees. So what did you see was the missing aspect of that market? What was that market missing that you felt Proudly could take advantage of and is currently taking advantage of?
Yeah. So when we started the company, it was really about a wouldn't it be cool moment, right? And the wouldn't it be cool moment was, wouldn't it be cool if we could capture the way money moved and embed a donation in it, right? So it was more of, and then we started getting to, the consumer side, mom at the grocery store, kid at Chipotle, someone paying their electric bill. And then the businesses, if you look at all the money, the way money moves in businesses, commission, payroll, vendor payments, disbursements, reimbursements, we go on and on. And it took about a year and a half to build the back end, but we figured out the best way to capture all that enormous spending was to do it on the payment rails that MasterCard and Visa had built for gift cards, right? So now what we then elevated that to was in 2025, which is where we sit, the elephant in the room is retention, disengagement. And there's a lot of statistics around recognition, increasing retention. Dear John, thanks for being a valued team member. We can't be a great company. So we take these motivating behaviors that we want from let's say the hourly wage community, restaurant, hotel, retail, where turnover is a very expensive undertaking. So if you think about the motivating behaviors employers want from hourly workers, would include referring new team members, right? Taking shifts that don't belong to them, upselling the menu, getting 5-star ratings on Google. And so when employees do that, right, the incentive is thank you for can't be a great restaurant. Your contributions are, and we tell them why, right? It's a whiteboard, but it's do something good today, get rewarded tomorrow. And these gift cards are very impacting to the recipients. My staff did an analysis on where the cards are being spent, and they're eye-opening categories: gasoline, childcare, groceries, electric bill, automotive. So now I've told an employee, thanks for being a valued team member, blah, blah, blah. And they're not splurging on themselves. They're actually spending it on places that are very important to their family or loved ones. So we do that all over the country. One of the neatest things for me is all the different ways companies are using us around recognition, reward. There's a concept, recognition isn't just to employees, it's to customers, it's to referral sources. These are relationships that build long-term advocacy. There's a statistic, right? Explicitly appreciated customers are 5 times more likely to buy again and 4 times more likely to refer a new customer. And that's the Harvard Business Review. So all the statistics are there on companies doing a better job on recognition and reward. So now we've made it easy. It's sent to a phone. It lives there in perpetuity. Every time your employee opens their phone, they're reminded of what they did. And then for us, the specialness is we have certain programs where on average, a percent of the load actually goes back to the employer to do something good in the communities that are important to them. So we kind of baked in giving into the card give, and that's incredibly interesting to everybody right now.
Can you expand that a little bit more about the giving aspect of this? So a certain portion goes back to the employer, and based upon your metrics, how are they using that? That it seems like it's very powerful.
Yeah, I'll just give you an example. So I'll show you. This is my own digital wallet. I think you could see that. So that's an open loop Visa card, our logo that would go to, and we can customize this. Corporate logos. It's got a lot of customization in it.
Mhm.
So let me keep it really high level. So if we sent somebody $100 card, we effectively would charge their employer $99 to do that, right? So there's no cost to do business with us. And then we take the 100 goes to the employee. We charge the client 99 and we tell them go do something good with the dollar. We don't charge you. Now multiply that by large workforces or millions of dollars that we issue. And so it has the closest thing to us, which doesn't exist anymore, was the way Amazon Smile used to work, right? You go online and Amazon Smile, and 0.5% was earmarked to a charity, place of worship, a nonprofit that you had been signed up for. But that's a consumer model. Someone goes online, buys something on Amazon. So what we took out of that playbook, or the idea was, we didn't grab it from Smile, but it's got some of the same elements. But we said, gift cards are a big business in the US and around the world, but for the most part, they're very unremarkable. That's why they go unused, right? And certainly physical ones are not with you. They're sitting, in your drawer at home and all that. But that's really the economics of kind of how the donations get generated is we take the card and we take a piece of the load and we automatically rebate it to the client for them to do something
Gotcha.
good. And we want them to go tell social media, go tell whoever's important to you, because most companies are really they're looking for solutions around recognition and retention, looking for solutions around doing more around giving. And so we check a lot of boxes in that, and we're doing it off of something that is easily understood, which is the bones of it is a prepaid gift card.
Okay. Well, thank you for sharing. That is just fascinating how that has expanded and how that continues to grow. So if we look at both Prudent Capital and Proudly, Glenn, when you were starting them, how did you capitalize these two companies?
Yeah, so I jumped so on Prudent. Prudent is I jumped on Prudent. It had been started by Steve Schwartz, who's the general partner. And basically has been funded with high net worth money. And then proudly, I have funded the company 100% on my own with my own wherewithal.
Right. Gotcha. And we had talked before as well that you, one of the first companies you actually scaled, grew the company, and you actually sold it. Can you
Yeah,
tell us
so
a little bit about that
yeah, so I was
business?
part of
About yeah,
yep, I was part of a management team. We sold a specialty finance company to Wells Fargo back in it was 2006, and then we were at the time one of the largest specialty finance companies supporting the defense industry, right, government contractors. And as I said earlier, in the ubiquitous world of money, it's really nice to know that the specialization goes a long way when you're telling your story to the right audience, right? Even given all the headwinds right now in government contracting, the U.S. federal government is still the largest buyer of goods and services in the world, right? And it's
yes,
shaking out right now and what goes on there. But
right,
what happened and the types of companies that we catered to back in the day were smaller companies that had very large contracts and they needed working capital for mobilization, startup costs, funding payroll, funding just operating expenses until they were getting paid by the government.
hmm gotcha. And when you started that company, the niche that you had then were finding contractors or finding businesses that were winning contracts, but they needed to fund them. Is that correct?
Yes.
Right. Gotcha. And it's so interesting that in that niche space there, that would a traditional bank lend these companies money?
Yeah, I'd like to draw a really big, distinct line in the sand between how banks look at lending money and how specialty finance companies like to lend money. Banks historically like to look in what I call the rear view mirror. And the rear view mirror has got the operating history, the financial performance, the financial reporting, all the profitability laid out. The specialty finance companies are more geared towards looking out the front windshield, new growth, new prospects, right? Kind of monetizing what's ahead of you. And that's a big difference, right? Especially at the lower end of the credit spectrum, because you could not get banks by any metric or any underwriting standards to provide the types of capital that we were doing for those types of companies. And these are great companies, right? They just, they were just, more. It could have been a startup, didn't have the wherewithal, didn't have a personal guarantee, didn't have a lot of the accoutrements that banks would require today. All that being said, I say the front windshield, rear view mirror analogy is really kind of was our secret sauce.
Gotcha. And so within the specialty finance, what vertical were you guys focused
I
on?
think you would put us under asset-based lending, kind of what I alluded to earlier. And I learned a lot from that and said, what are the opportunities within the asset-based lending business, right? And that was kind of the real interest level on the mezzanine stuff, right? Knowing that, the asset-based lenders, and there's dozens of them that all like to do the same thing and call on the same companies. And we want to sort of bring that additional tool to them that allows them to accommodate what a borrower needs, right? Not just lending to under assets, really a true capital structure, capital stack. And that's really probably the best thing to come for me to come out of my asset based lending experience was to understand how do we do more work with asset based lenders. and we're compensated for it, right? Our yields are above, because it's unsecured lending, it's term lending. But that was really one of the key drivers of going, this makes a lot of sense to bring some element of risk-based capital to the asset-based lending world, and everybody lives kind of happily ever after.
Right. And then, and again, with a particular focus on companies that don't have years of a track record, perhaps, that again, you all found a way to do it from a profitable standpoint, that you felt the challenge that CEOs of companies had. But again, these may be smaller companies that didn't have that long history.
Yeah, I look at I kind of, another analogy I like to kind of give on, if I took every company in the US and kind of stuck them in this triangle, right, and kind of rated them from 1 to 100, like, and that's, just as a round number, 25 or 30 million companies, right? So whoever we put at the top is a well-known publicly traded company, and the company in the left-hand corner that we rank 100 is what we just described, right? Small, getting there, and all these things. And if we sort of break that triangle, you got the top 10 percentile, that's sort of going to public markets, public equity, public debt. The next quartile, the next 25% of companies, which takes you to the 35th percentile of the triangle, that's where all the banks operate, right? Good companies, review mirror, financial performance, financial history, financial reporting, guarantee, collateral. And then you got the next, from the 35th to kind of the bottom of the triangle, that's 65% of the businesses, right? That's where the non-banks operate. And so there's not yield compression, there's disintermediation, as I described earlier. There's a lot of companies that fit in that lower part of the triangle, and that's that people in the non-bank world, that's who we sort of cater to.
Right. Oh, thank you for sharing that. I think that will make it clear, particularly for a lot of CEOs, to understand where they are in that space from a capital market standpoint. So how they relate to banks and identify who the specialty lenders are that may be able to help their business.
Yep. Yeah,
Great.
100%. And it's really hard. CEOs of growing companies, they rely on their service providers, right? Their accountant, their lawyer, or somebody close to them, their banker,
Right.
who may or may not get there. We see a lot of times in banks like to call on companies. That's what most bankers' jobs are, call on companies in local markets. But when they get to, there's a lot of products and services that businesses need: checking accounts, operating accounts, credit cards, all that, typically good to go, no matter what the credit profile is of the business. Where the fork in the road occurs is the credit ask, right? So a lot of times specialty lenders will call on banks to educate them on their client base on how they can assist until that company is ready for more traditional bank financing.
Right. Thank you very much for sharing that. No, that is a very good point that you made. Looking at your experience with Prudent and with Proudly, can you share an example of a calculated risk that you took that paid off in being able to scale those companies?
Yeah, one of the stories I like to tell, which is awesome. So early in 2000, I had a gentleman working for me at the time from Baltimore, and he brought in a little apparel company um, that needed $3 million of growth capital, and the company ended up being Under Armour. So what happened was, and nobody knew at the time, right? So it was a $3 million term note, non-dilutive. They needed the money, inventory, um, so that was kind of cool, right? That was the most notable company. Most of the companies that we have funded over the years have all been privately held, but have gotten there in a variety of different reasons. But that one story really resonates, right? Because you just never know. So again, we talked early in this conversation about non-dilutive. That was a classic non-dilutive financing, and the money that was needed up and above what the bank was providing was for raw materials for the company to grow.
Can I put just use that example, just the Under Armour example of that non-dilutive money. So that's more of the mezzanine product. That's more of a
Yeah,
prudent, right?
yeah,
And so
yeah.
when we think of mezzanine, their CEOs are thinking about that. You described it a little bit. So from your standpoint, mezzanine, the term is usually going to be 3 to 4 years for a particular purpose,
Right.
subordinate as a second lien behind the existing bank. So given that existing risk profile, the company has to have very strong cash flow that you stated before. And what's the range of rates that a company should look to pay for a mezzanine type loan?
I think that it depends on the place that we're marketing. We're probably in the 18 to 20% yield on that, and it's not all current. It could be 12 or 13 current, and then there's a payment in kind called a PIK at the end. Um, Bigger deals, somebody that would need $50 million mezzanine, their yield would be way lower, right? And that's just it. So, but there's efficiencies again, as I mentioned, to that market. A lot of the funds kind of are swinging it out with each other to kind of make it you know, make deals work. But for the most part, right? So, we always say we want companies to max out on their bank financing. It's the cheapest part of the capital structure. So we're always all in on what will the banks do? They'll do a revolver. They'll do maybe one turn of EBITDA on term note. So we're very much in play here on making sure that the company's got the ultimate capital structure.
Gotcha. Thank you for sharing that. Thanks for sharing that. And with that example, is there one with Proudly as well?
Yeah, we have a lot of things that go on with Proudly, right? So statistically, what we're doing with our customers is we're creating incentive and reward programs for a variety of reasons, right? Company, we had a company there, a last mile Amazon delivery company, and the problem they were having was with turnover, right? 150 drivers, and they didn't really know kind of how to make their drivers happy. Weather was bad, somebody doesn't show up. It's got a massive impact to the analytics of what they're doing with Amazon. We did a program where, again, the drivers are doing what they're doing, safety, reliable, all the above. Thank you for your attendance, like all the messaging that went on that. And basically the retention went to 100%, right? And they're compliant, like everything they needed to do, right? Um, We've done a lot of work with companies all over the country, all different industries, solar, defense contracting, law firms, everything. And the bottom line to all of our programs is that I said this earlier, what are the motivating behaviors that the employer wants? And that's what our programs are supporting. So we have programs that have been successful in reducing turnover and people participating in healthcare incentives. Um, we're doing some work with nonprofits that's really interesting to me in the movement of money to vulnerable populations, right? We have a bunch of nonprofits, DC based nonprofits, donations come in. And the dilemma ends up being is how do you get the money to the recipient? And these are families with food insecurity, you need money for school supplies, whatever. And most of them fit in a category in bank speak considered underbanked or don't have access to this banking system. So you can't really write them a check and you don't really want to provide cash. So providing a digital card with funds on it for them to buy food or things like that. So that's actually really been very, very cool for us, right? So corporate clients of all different shapes and sizes, reducing turnover and sending healthcare, self-care, those types of things. We do a lot of work for companies on referrals, right? So they want to incent customers to refer new customers. One of our customers is very big in the trades in the solar energy business, and we run all the programs for them. And it reduces their customer acquisition cost almost 80% because it costs them a certain dollar amount to find the customer. And if an existing customer refers another customer, right, we're sending them out money on a card, and it's a win-win for everybody. Really easy to do. We kind of say easy to issue, awesome to receive.
I love that. Easy to issue, awesome to receive. You know what? I think part of the hidden genius there is, Glenn, when you think about companies and CEOs trying to grow and scale their company, we're so much focused on perhaps our customer, our strategy, et cetera. Um, but it's really so much that human behavior, how we treat people. Some of the old-fashioned things we may have learned when we were real little, but how do you treat people and how do people feel after they engage with your company, with your business or your product, your service? And this seems to be an ingenious way of being able to say thank you.
Yeah, exactly. I cannot overemphasize in 20, John, you bring up a good point there. There's an old saying, it's not what you say to people, it's how you make them feel, right? And there's some truisms to that. So again, I read a really interesting article on pickleball that I applied to Proudly. And the article was Why is it so popular? And
Right.
the short answer is because before you play it, you already understand 80% of it, right? It's that last 20%, the rackets, the ball, the court, all that's easily understood. It's that last 20%, right? All the different ways you can play, the kitchen, kind of the uniqueness of the game. And Proudly's built the same way. Everybody understands 80% of a gift card. You don't have to explain to anybody about a gift card. What we did was we took that 80% and we made the last 20% better, right? Custom, digital, piece goes to charity, recognition, reward, incentive, which are all the big, people are looking for solutions around that, right? There's a statistic that I've seen in the hourly wage community, and that is a $15 an hour employee, the turnover, the ultimate cost of the business is close to $4,000 with the cost of re-recruiting, retraining, rehiring, and lost productivity. And so I'm not advocating that the gift card saves the planet, but what I am advocating is that people statistically want to be recognized monthly, right? So however you do that in your business, but we said, we're going to do it under how gift cards get done, but just make it a better end user recipient experience, appreciated. Again, do something good today, get rewarded tomorrow. And it's been a very effective tool for our clients who are looking to check boxes around, retention and more of this, and less of this, and then sending team members to do that. And that's what we support for them.
No, and I think it's what you said there so critical is just the timeliness of it. It
Right.
seems like it's very flexible that if Glenn, you do something that's great today, it can get you that that thank you, but I can give you that recognition today as well.
Yeah, and that's how you make them feel. And so we were just talking about, that's a really, really, really strong component. So we went from 4 years ago from this wouldn't it be cool moment to this company that has clients from Hawaii to Florida, everywhere in between, and doing really cool work. And hopefully making a difference to the companies, not only in their recognition, reward, incentive programs, but also the piece of the donation that gets generated off of what we're doing for them to support causes that are important to the communities where their people live.
Right. And I think that last piece you said is very important. It gives them control from a philanthropic standpoint or just to give something standpoint. So not only do they feel good from a recognition standpoint there, but it's giving them, that control of where and how they want to direct their dollars in their communities.
For sure. For
Yeah,
sure.
fantastic.
Yeah.
So with Proudly, how are you scaling in terms of marketing, market share? What was the initial strategy there, and how has that been panning out for you?
That's a great question, right? So I'm going to take a playbook out of Fintech 101. Early onset Fintech 101 was kind of Fintech and the incumbent is the bank. And then what Fintech learned kind of by trial and error was that 99.99% of all businesses in America have at least one bank product, and that's an operating account. So that said, the Fintech, the customer that I want to do business with has an operating account here, but nothing else. They don't have my widget, whatever my widget is, my Wealthfront or Robinhood or Invest. They don't have it. So now that moved to Fintech 2.0, which is a collaboration model, right? Hey, Mr. Incumbent, we think you should be offering your clients fill in the blank. This payment product, this lending product, this investment product, right? So for Proudly, the model for us is everything that we do uses that philosophy. Our partners who are substantial all are the gatekeeper for the client. So it's banks, it's PEOs, it's employee benefit brokerage firms, and it's payment companies. And so the things that we're brought into, if you understand, as I've explained, what Proudly does and the uniqueness of us, this employee recognition, retention, incentives that has social good built in is pretty interesting to everybody. It's interesting to the benefit brokers. It's interesting to banks. It's interesting to PEOs. So our marketing and scaling is all about building partnerships with organizations that have clients where our products help them do more with their workforce, with their customers, with referral sources. And that's kind of how we're building out what we're doing.
Okay. No, it's great. I really see the through line to, um, number one, partnering with other organizations, but then also it's helping them become better partners to their stakeholders, their employees, their customers as well. So it's helping them look good and look better to their customers, to their stakeholders. And that gives them all the incentive, even more incentive to help use proudly going forward.
I say this more simply. In all of our partners, we have to help them do one of two things. And that's either accommodate a customer or help them acquire a customer. And helping somebody acquire a customer says in, let's use the employee benefits industry, this helps somebody differentiate themselves when I kind of described it often, they got to climb over a lot of bodies to get to the prospect, right? And the fact that they can offer something that's interesting and unique to the prospect, if that helps them win their core business, that's how a lot of people use us. They use us as another tool for them to do more in the markets that they serve.
Right, right. And you've got these two companies within the holding company. And Glenn, at this point, what do you think your superpowers are, and how did you discover them?
I say this, when you start a company, you got to have the answers to these three questions really succinct. What problem are you solving? Who's willing to pay for it? And what's your method of delivery to that solution, right? Again, what problem are you solving? Who's willing to pay for it? And what's your method of delivery? And I think each of those have kind of a different, different answers. But I think we could parcel all that together. Problem we're solving, employee disenchantment or employee disengagement, right? It's a huge problem. A good friend of mine, Andrew Sherman, wrote a book on the problem of disengagement, right? The numbers are staggering on what it costs American businesses on disengagement. So we want to get people engaged, right? So I think that in both of them, we find that there's a problem, right? You open up, a place to cut hair. That's your problem we're solving, right? Who's willing to pay for it? People that need haircuts. What's my method of delivery, right? Whatever skill. So it's a tried and true kind of model on businesses, right?
Right.
Healthcare services, everything. So I think both of that's really kind of the, how do you get off the dock, and you got to have those three rock solid on where you want to go with them.
Right. No, thank you for sharing that. And so, from an Aspen Hill standpoint, from a holding company, and I guess for Prudent, and for probably as well, what's next for you as the CEO driving these companies, and then what's next for the companies themselves? Like, what's the next hill to climb, next challenge?
Yeah, I think Proudly's got probably a really long runway to do more around things that we're doing. I don't really, a lot of times I've said, I get asked a question like with Proudly, like, what's your goal? We're going to sell it, like all, and like, so I'm, I'm not there, right? I'm really, we want to enjoy what we're doing. We want to, we want to do more. I don't have a great answer to either of those questions. I think that people need to enjoy it. I think if you sort of start a company, just say you want to try to sell it. There's a school of thought that that's the only way you should start a company, and there's other schools of thought that nope, just get really good at what you do. And the world will find their way to you. And I'm more the latter. So I don't really I don't have this long, one of the reasons I'm proud I don't want to raise any external money was because I didn't really want to, I didn't want to have to go the equity route and go, oh, I'm sitting in pipeline meetings or what's my, right? So that was really on purpose, to be honest.
Yeah, Glenn, I get the sense with Proudly that for you, and you mentioned not wanting to acquire capital from the outside, part of what's reason your motivation for doing this is there's a lot of professional satisfaction out of Proudly for you beyond just making money.
Yeah, 100%. I kind of describe us as like a social enterprise where you could do good and do well, right? So we have economics in the business. But you could, we could do a lot of really neat things. And I think the business in general and finding, I'll go back to what I said a little bit earlier. There's the coolest thing about everything in finance right now are really fundamentally new ways of doing old things. Forget AI for a second. We're just talking about, again, instead of writing somebody a check, you send them Venmo. Think about just how game changing that is. Or again, the ability to trade on an algorithm like Wealthfront instead of having a full service broker. And so I'm really, and this to me as a father of four, I'm incredibly bullish on this next generation around things like this. There's a lot of blue sky around all these different elements of finance, and so I'm really enjoying doing what we're doing. I co-founded the company with my oldest son, who handles all the internal operations. So that's kind of a neat story. We were just voted again in the DC area. We're nominated third year in a row, one of the most innovative companies in finance. So, so we're getting external validation, not only on the client uses, but, there's just organizations that are finding us. We were Entrepreneurs of the Year a couple of years ago in one of the local areas here. So, and again, for me, that just validates what we're doing. It's not about the award. It's really just about people that are kind of bringing us into the fold. And that's kind of neat.
Gotcha. One last question on Proudly. Is there a minimum usage with Proudly? If I have one employee, can I use it? Can I do a one-off to one customer? Or is it more looking at it on a mass scale?
No, we're good with, what happens with us. What's really neat about the business is we start with something and you start with one employee. Next thing you know, man, you want to send something to all your customers. Next thing you want to know, you want to send something to all the people that you want to try your product in. And that's what happens with us, man. It's so easy to use. And we support, again, use case number one is your employee special holidays. Use case number two is all your customers that bought a certain amount. Use case number three is we could fill in the blank. If you give me, an industry, we can go back and forth on all the unlimited use cases. And that's kind of normally how we grow with customers. They start using us for one thing. And, next thing we know is seven use cases later, we're doing stuff for them.
And Glenn, what would be the final message you'd have for CEOs who are listening, who are growing and scaling their own businesses? What final
man,
wisdom would you leave them with?
If it was easy, everybody'd be doing it. Man, it is not easy. What you think is a great idea, like me, but I just know, man. You're doing the right things. Whatever your thing is, man, it's the right thing. But if it was easy, everybody'd be doing it.
Well, Glenn, we wanted to thank you for being with us today and sharing some of your valuable insights and time. And again, congratulations to you and your teams at both companies.
Appreciate it. Really good to be with you today, John. Yep. Thanks for having me.
Thank you for being with us.
Okay.
And remember to follow us, subscribe to C2 Biz Growth. Thank you.
Thank you for listening to the C2 Biz Growth Iron Sharpens Iron podcast. And check us out on social media, share, and subscribe.